Well, retirement is a time to enjoy the rewards of years of hard work. But I got to tell you, understanding how taxes impact your retirement income is even more essential. So I think that's why Mary from Charleston asked, "Hey, Hobart, I'm 60 and I'm planning my retirement income strategy. What are the main taxes I should be aware of in retirement?" Well, Mary, that is such an important question. You see, taxes are a key consideration for retirees, and knowing which ones to look out for can help you protect more of your hard earned money. So, here's a rundown of the main taxes that could impact your retirement income, as well as some tips on managing them. Number one, Social Security taxes. Yes, Social Security benefits can be taxable. Hasn't always been the case, but it is now. If your combined income, adjusted gross income plus half of your Social Security benefits, exceeds a certain level, up to 85% of your benefits could be subject to federal taxes. Now, in South Carolina, however, Social Security benefits are not subject to state tax, which is a bonus for Charleston residents like you. Number two, required minimum distributions, or RMDs. Once you turn 73, the IRS requires that you start taking a minimum distribution from most retirement accounts, like your 401ks and your traditional IRAs. These distributions are taxed as ordinary income, which in turn can bump you into a higher tax bracket if you're not careful. So planning ahead and possibly starting Roth conversions before age 73 can really help lower your future RMDs and your overall tax burden. Third, taxes on your pension and IRA withdrawals. If you've got a pension or you're withdrawing from those traditional IRAs, not as a mandatory distribution, but just for fun, those distributions are also taxed as regular income. So it's wise to plan your withdrawals carefully to avoid being pushed into higher brackets. Some people stagger their withdrawals or mix them with income from tax-free accounts like Roth IRAs to help spread that tax impact and keep them in a lower bracket. Fourth thing to keep in mind, capital gains taxes. If you sell investments outside of retirement accounts, you'll pay capital gains tax on any profit. Long-term gains are taxed at a lower rate than short-term gains, so holding investments for over a year can save you or at least be a bit beneficial. If you're selling large assets, try spreading the sale over multiple years to minimize your yearly taxable income. Sell some stock in December and some in January, and you split it between 2 years. Number five, taxes on inheritance and estates. Now, in your case, South Carolina doesn't have an inheritance or estate tax. It's still good to keep federal estate tax rules in mind if your asset is substantial. The thing is, you may want to talk to a tax advisor about gifting strategies or trust options if estate taxes could impact your legacy. I think the key takeaway here is taxes can have a really big impact on your retirement income. Too many people just don't think about those. But with strategic planning, you can minimize their effect. A tax-efficient withdrawal strategy and possibly some pre-retirement moves, again, like Roth conversions or investment sales, can make a big, big difference. Mary, thanks for your question. To everyone else watching, don't hesitate to reach out if you'd like more tips on tax-efficient retirement planning. Specifically, if you're not in South Carolina, there's some great tips that are out there as well. Now, question I have for you is, what's one tax-related question that you've got about retirement? Leave your question in the comments below, and we just might answer it in a future video. And if you enjoyed Mary's question, don't forget to like and subscribe, and also share this video. Drop your own tax-related questions in the comments. We're here to help make the most of your retirement. Have a great day.